An inverted yield curve shows that long-term interest rates are less than short-term rates. An inverted yield curve implies that investors expect lower interest rates at some point in the future. Yield curve inversion is closely watched by financial world because every U.S. recession in the past 50 years was preceded by one. 2-year yields usually move with interest rate expectations, while 10-year yields move with growth and inflation. The U.S. yield curve has been inverted since last year. It reached a multi-decade record in the third week of June 2023, as the spread between the U.S. 10-year Treasury yield and the U.S. 2-year Treasury yield reached 97 basis points. This represented the widest gap the curve has experienced in more than 40 years, dating all the way back to 1981. This is typically a warning sign that recession could follow soon. U.S. funds are currently betting on even deeper U.S. yield curve inversion, meaning that those fund managers expect a recession in the next 1 to 2 years or sooner. The inversion of the yield curve has been seen by financial experts as a useful tool to forecast a future recession. Historically, the last 2 extended periods of inversion were followed by recessions. Most notably, the yield curve inversion that occurred in 2006 to 2007 was a precursor for the Great Financial Recession of 2008 to 2009. Additionally, prior to the 2001 to 2003 market meltdown, investors watched the yield curve invert in 2000. While nobody is able to tell with 100% certainty if a yield curve inversion will be followed by a recession, the current yield curve inversion is a possible indicator of economic slowdown beyond U.S. shores. Global economies, including UK, China, India, are closely watching the U.S. yield curve developments. And that's all for today. Thanks for watching. Please like, share, and subscribe if you found this channel useful.